welcome. You're watching Financial Planner, and today we'll talk about the importance of debt in your portfolio. Joining us in the studios is Feroze Azeez, Deputy CEO of Anand Rathi. Thanks, Feroze, for joining in today. And we talked about equities and the importance of equities and the types and ways of investing in equities through mutual funds in our previous episode. Today I want to talk about, firstly, what is debt?
See, I think importantly, debt is nothing but lending to a corporate is called debt. Simplistically, if it is lent to a corporate, it is called debt. Generally, the more commonly used nomenclature, which is fixed deposit, is lending to a bank. So anywhere you lend your money to somebody, that is called debt. Like if you lend money to your friend, it is called debt. So generally, when you lend to a bank, it's called a fixed deposit. Depending on whom you're lending to, there will be different names. But debt as a concept is lending to somebody. Okay,
let's break this down for the sake of our viewers. How important is the role of debt in a financial portfolio?
See, in a country like ours, debt has a very large role to play in the financial planning and the aspirations of one to meet his goals. It brings in huge stability, which is the key attribute of debt. Okay, because if you've lent to somebody and if he's committing you a specific interest rate, that interest rate becomes the anchor to the portfolio to make sure it has the capacity to absorb the volatility which the other portion of the portfolio, which is going to be largely equity, is going to bring to you. So to bring a balance between volatility and stability, debt becomes a very important integral part.
So fair to assume that equities do the job of wealth creation, while debt should be used to create stability in the portfolio?
Correct. I think if the roles have to be defined in this fashion, I think that's very, very clear and categorical.
So just to, we'll very quickly go through this. So is it fair to assume then again that debt cannot be used for long-term wealth creation in any form or the other?
Correct. If you look at wealth creation, a large portion of the wealth being created over last few years or decades or in the future is going to be propelled by equity.
Okay.
And equity is a long-term asset. But unfortunately, what happens is in the short run, it gives you a lot of ups and downs.
Right.
And those ups and downs become the cause of a person to not live that journey. So debt gives you the courage to live through this short run to arrive at the long run. So debt is nothing but a hand-holding kind of an attribute which it brings to an investor so that he can see the long run and pass through this very, very tough emotional short run, which the equity tries and brings to the portfolio.
I know it's difficult to give a recommendation because it's not as if one strategy is going to work for everybody, but what is the ideal recommended percentage of your portfolio that should be allocated to investing in debt?
Correct. But I think even if it is not individualistic, even if it has to be goal specific,
okay,
in the short run, debt is going to be an overpowering larger component of the goals, of the money which you've set aside for your goals, which are in the short run.
Okay.
That can be as much as 80-90% or even 100% if the goal is closer to where we are today.
Okay.
If it's medium run, then I think not more than 30% can go into equity. So 60 to 70% has to be in debt,
okay,
because medium term also equities could be very risky and it can make sure that the goals don't meet. So debt becomes a larger component in the short-term, medium-term goals. In the long-term goals, in my opinion, it has a very, very small role to play because you have time to try through the volatility which the equity is going to have in store for you. So long run, 20% debt is the maximum you should go. Long run, by which I define it as greater than 5 to 8 years. In the medium run, you can be as much as 70% in debt. In the short run, almost 100% could be in debt, depending on how close the goal is.
Right. So as you get closer to your goal, even if it is a long-term goal, the recommendation is you switch out of equity and move the money to debt if your goal is only about 2 to 3 years away, even if this is a long-term goal that you've spent the last few years working on.
I think it's a very valid observation. It's a very, very good observation. As you progress, the long-term goal at some point in time will become a short-term goal. Because if you've planned for 10 years and if you've finished 9, then you just have 1 year for your goal to be met. So your risk appetite with respect to that goal comes down. So move money from equity to debt is a very good strategy.
Now, what are the types of instruments available to invest in debt? More often than not, at least in the last 1 year, we've all talked about how financial savings in India are getting more evolved. Till very recently, India was only investing in fixed deposits or yeah, that was pretty much what we were investing in. That, of course, is now changing. I know fixed deposits is one type of a debt instrument. Take me through what are the various instruments available for one to invest in if you want exposure to the debt market.
Correct. Let me pick a valid point which you actually made, Samina, was to say that India is going through a transformation in terms of their learning of how to manage their finances. And that is clearly coming out as a trend, because 5 years back, Indians had 40% in financial instruments and 60% in physical assets like gold and real estate. Now that trend seems to be clearly depicting that now, as we speak, it's 50% in financial assets and 50% in physical. So as we progress, I think the financial assets as a component of one's Indian household savings is going to go as high as 60 to 70%, which I think is a very good thing. Coming back to debt, like you again pointed out, that fixed deposit is what was synonymous to a debt investment for an Indian. I think that myth needs to be broken, because 20% of the household savings approximately in India are going into the most inefficient debt instrument, which is a fixed deposit. Okay. Why inefficient? Because it gives you, of course, an interest, but the tax implication of that interest is on your marginal tax rate. Most often than not, if you are in the higher tax bracket, a fixed deposit becomes an inefficient instrument. So it's important to understand the rest of them and their merits, so that we could probably ensure that your monies are being channelized to efficient debt instruments. Firstly, fixed deposit and recurring deposits, which are the same similar thing, have a very good advantage of a period of your choice. You can have a 7-day FD to almost 20-year FDs. Okay, gives you the benefit to lock in interest rates. So time frames is very vast. The return today is ranging between 6 to 7%. If you have to keep that, and tax is inefficient and it's as per your tax slab. Anybody in the lower tax bracket should be smart enough to use a fixed deposit, but anybody in the higher tax bracket, it's a very detrimental thing to buy a fixed deposit. Now moving on to the other instruments which have some degree of efficiency, one is a tax-free bond. Okay, government-run companies issue tax-free bonds, which today give you an yield of 6.1 to 6.2%, and they have the potential to lock in the interest for 7, 8, 10 years of 6.1, 6.2. As the nomenclature suggests that these are tax-free, all what you earn is going to be absolutely tax-free. So 6.1, 6.2% interest tax-free locked in for long periods of time is what a tax-free bond can do for you. If you move a little further, then you have an very important asset class, which is a mutual fund, which helps you take care of your debt needs in a far more efficient and a tax-efficient format. And then you have FMPs, again in the mutual fund category, which are called fixed maturity plans, which is abbreviated to FMP. So these are the few instruments on the debt category a person should definitely consider over and above a fixed deposit. And I think that'll in this interest, when the interest rates are about 6, 7%, not letting go of tax efficiency will bring you back to interest rates of 2 years back, whatever those interest rates of fixed deposits were. So I think going beyond a fixed deposit for an investor is one of the most prudent things to do.
Right. On that note, we'll take a break. We'll come back. We'll tell you the parameters you need to consider while you determine what debt investment you want to make, and of course, keeping in mind your risk profile and your goals. So stay tuned. Welcome back. You're watching Financial Planner, and today we're going to be talking about debt as an investment vehicle. Feroze, in our previous segment, we talked about the importance of debt and, of course, a recommended allocation one could look at while investing in debts in the debt market and the types of debt instruments that are available. Now, tell our viewers what one needs to consider while choosing the right debt instrument, of course, to suit their goals, to suit their risk profile. What are the factors that contribute to this? So I'll take you through a few that I've listed, and, of course, you've got to elaborate on that. One is interest rates. So take us to the importance of keeping an eye out on the real interest rates and what that does while investing in debt.
See, it's very important to be clear of what are the macroeconomic situations you would derive your strategy from. Firstly, if you are looking at a fall in the interest rate, as we have had a fall in the interest rate for the last 1.5, 2 years. If you expect that to continue, it's very prudent to lock in the interest rate for as long as you can.
Okay.
And if you expect sharper falls of interest rate, then you need to not just lock in your interest rate, you also have methods to benefit from a fall in the interest rate. Okay, so how do you lock this in? So if you look at where we stand today, okay, the real interest rate in India, real interest rate is nothing but the interest rate minus the inflation, which the government publishes, is at the highest over the last 3 years, because inflation has come down significantly more than the interest rates have come down. So this data point gives you an indication that there could be further rate cuts and a further fall in interest rates. From this is where you derive your strategy of how you're going to manage your debt over the next couple of years. So interest rates falls are inevitable. Will they happen as steeply as they happened a couple of years back? The answer is no. But will they continue to happen and there will be a gradual trending downwards? The answer is yes.
So that's your outlook on where rates will go in the country, and therefore what one should do with regard to locking in. So they should, your advice is one should lock in at the current interest rate. Fair to assume that, or you'd actually wait it out?
No, I would lock in the interest rates. In fact, I would go one step further and would not just lock in my interest rate, would also want to get more than the current interest rate on the basis of the fall in interest rates.
Talk about that in a minute, but let's also talk about credit risk, because beyond interest rates, which is only one parameter that determines investing in debt markets, credit risk is important because a lot of mutual funds or investors would consider lending to a corporate, which is where credit risk of a corporate comes into play, right? I mean, how credible is a corporate? How important is that aspect?
See, I think credit risk is one of the biggest risks known to mankind, because it's an all or nothing kind of a risk. If you put your money and if the company goes bankrupt, it's unlikely that you will get anything.
Yeah.
See, a market risk basically can eat away 10%, 20% of your capital. But credit risk fructifying is like washing away your capital. So is credit risk one of the most important risks of debt? The answer is yes. Do you have to understand it, comprehend it before you take that? The answer is of course a yes. Now, if credit risk has to be analyzed, general tendency of an investor is to look at the ratings which the company generally produces, because rating agencies rate corporates, AAA, AA, and so on and so forth. So if your investment is going to be only on the basis of credit risk, measured in the form of ratings, it is not a very prudent thing to do. Delegating your credit risk management to a fund manager is very, very important, because you get two benefits out of it. One is diversification. If you bought a mutual fund, then you automatically have lent to 50 corporates. That's an average of 2% per corporate. Even if one of them goes bankrupt, it will not break your bone, right? So that's very important. And the second thing is a fund manager measures credit risk very differently than an individual does. There are formulas which are available in finance. For example, there's something called Altamount Z-score, which measures the second decimal probability of a corporate going bankrupt, right? Would a lay investor be able to do it who doesn't have the time? The answer is no. So delegating credit risk management to a fund manager would be a very nice thing to do.
So investing in corporate bonds through a fund is probably the best way to do it. And for whatever it's worth, I think rating agencies are the last one to react to any sort of bankruptcy or default by corporates. Expense ratio. Why and how important is this while determining what debt one should be investing in?
See, you're bringing me to very valid points. Expense ratio is a very important part. See, what happens is, expense ratio, let's assume a fund has an expense ratio of 2%. Right? But in debt, that's too high to pay, because you're going to make 7 and pay 2 out of it. Right? In an equity fund where there is huge value being created by the fund manager and your aspiration is to make 15, 17%, 2% being paid is a smaller proportion of what you're going to earn. Here you're going to earn 7 and then you pay 2. It's like giving away 1/4 or even more of the total interest which you were supposed to get. So you have to be more sensitive to expense ratios in a debt fund, more so in equity funds.
And Feroze, even if returns are not your priority with regard to debt fund, because this is not equities, right, where you're playing the game to create wealth. If this is about stability, then even then you'd imagine that you should keep an eye out on the returns that debt funds are giving you?
Absolutely, yes. Because see, today 5, 7%, 8%, but 3 years is the time frame where debt becomes
It's
tax
done,
efficient. So when you speak about 7% compounded, then you've earned 25 rupees in 3 years, and that interest also comes to provide security to your equity. Because if you have a 50-50% portfolio, let's assume equity and debt, then you actually have a natural hedge in your portfolio.
Okay.
Because this 50 rupees will become 62 and a half. Okay, in about 3 years, which is about 25% growth. And even if equity markets are 20% lower, your 100 rupees protected,
Right.
which happens in India. But if you are a US citizen, it's not going to happen because your 50 in debt will only move to 52. And this 50 in equity can actually go down to 30, right? So there's a natural hedge because of the high interest rate in debt. So it's important to keep your eye on the interest rate because that's also going to provide a risk cushion to your equity.
And therefore, tax efficiency also is going to be important, right? How tax efficient is a debt instrument?
See, different instruments have a different tax implication.
Right.
In my opinion, debt funds are the most tax efficient because they get this concept as per Section 48 of income tax, which is indexation. So when there is indexation on a debt instrument, then automatically your tax implications come down to minuscule. So your pre-tax and post-tax difference in a debt fund over the last 3 years have been as little as 0.2%. So that's a good tax efficient instrument to not let go of. So tax efficiency is important.
Feroze, when one is looking at calculating the returns through debt, you mentioned to me that one can make more than just the interest that they get on an instrument. And you also alluded to the fact that one can make some more or make a beta on low if interest rates are going to move lower. Can you help our viewers understand what that even means? Because for most of us, if you see a return of 6%, it is 6%.
Yes, so there are 3 sources of making money in debt. And different instruments help you make money from these 3 sources.
Okay.
A fixed deposit, unfortunately, only helps you lock in the interest rate.
Yeah.
And debt funds actually are able to give you all the 3 benefits if chosen wisely. What are these 3 benefits? One is, of course, the interest, which is apparent to naked eye,
Right.
and you know that's the most common thing. Second, when interest rates go down, if you have locked in a higher interest, the instrument which you have bought is now going to be giving you a better price because you have been smart enough to lock in the higher interest rate. For example, if your instrument has locked in 8% interest for the next 10 years, and if interest rates come down to 6%, then automatically, since you have been prudent to lock in 8% for 10 big years, your bond or your instrument is going to be at far more demand and valuable. So that's called interest rate risk and the benefit derived out of it. A debt fund can do that for you, a fixed deposit can't. Why can't a fixed deposit do that for you? Because fixed deposits are not transferable. So if I have my fixed deposit, can I sell it to Samina? The answer is no. I can only surrender it to a bank. But a debt fund can be sold.
So you can trade it.
Can you trade it? Then the third is when you buy a corporate's bond, if he is rated lower and if his company becomes stronger and if he gets a rating better than what he had, then you make more money. So net, if you buy a debt fund prudently, if the interest is 7.5%, you might end up making 8.5%, 9%.
So debts such as these that you just mentioned, could they be used as high risk, high return kind of vehicles?
Yes, marginally higher on the risk side, like you pointed out. But I think if you can get 1.5%, 2% more than the prevailing interest rate, which the professional can add value, then it's something which you would not want to let go as long as risks are managed by diversification and professional management.
Right, so it's getting beyond fixed deposits. And I guess that would... on that note, we'll take a break. We'll come back. We'll tell you about how you could invest in those debt mutual funds and the various types of debt mutual funds that are available in the market. So stay tuned. Welcome back. You're watching Financial Planner. We'll tell you now the various types of debt mutual funds available to you. Feroze, in our previous segments, we talked about the factors one needs to consider while determining what is a potentially good debt instrument to fit your goals and your risk profile. Now tell us the various types of debt mutual funds available, right? So for the near term, are there any specific debt mutual funds or types of debt mutual funds one could look at for the near term goals or the near term or high risk, low risk sort of goals?
Correct. I think debt mutual funds as a basket actually addresses a 3-day investment to maybe a 20-30 year investment. So in the debt fund category, short term, there are 3 types or 4 types. Let me say all of those. Liquid funds, which you can park your money, earn about 5 to 6%, 5.5% post tax if you took a dividend reinvestment option. You can park your money over a weekend as well. Large corporates do that. Park their money on a Friday, take it back on Monday. So that's a very, very short term parking. Second, where generally from a financial planning perspective, you can keep your contingency fund in a liquid fund to access.
So instead of a savings account, you should put in a liquid fund.
Absolutely. And today, technology is helping liquid funds in the form of an SMS can help you redeem and invest.
Yeah, I heard about that. Yeah.
Right. So that's liquid fund. If you want to actually invest for about a month, month and a half, there's something called the Liquid Plus Fund. Like the name suggests, the risk is marginally more, but can give you 0.5% more interest rate.
These could be treated as your bank account, right? I mean, pretty much your savings account.
Correct. So they can definitely substitute for having a lethargic savings account to something which is going to be
Slightly
twice as more effective.
Right. Moving on from your 1 day to 1 month, beyond 1 month, so near term?
See, there are some funds called arbitrage funds, which I think are the most sensible to do today. If you have 2-3 months, which most of us end up having 2-3 months, unlike a corporate, which needs money over a weekend in a week's time. So arbitrage funds, the good part of arbitrage funds is they have a very low risk, but they are categorized from a taxation perspective as equity funds. So taxation is very, very beneficial in an arbitrage fund. Risks are significantly lower. So if you have a 3-month time frame, you will be able to make 6% post-tax in an arbitrage fund.
So risk profile is one of debt, but tax efficiency is one of equity. So it's best of both worlds, and that's probably the best way to describe it.
One point to be made there is you have to choose a dividend option only in an arbitrage fund.
Tax efficiency. Right. Even in your liquid and dividend reinvest is probably the best.
If you're in the lower tax bracket, growth is better. If you're in the highest tax bracket, dividend is better.
Okay. Moving beyond the 3-month time horizon.
Yeah, if you go from 6 to 12 months, there's something called short-term funds. As again the name suggests, they're short-term in nature. If you have periods of less than 12 months, then a short-term fund without an entry-exit load, which is the most important criteria when you invest, because there are short-term funds which have exit loads as well. Unlike the previous 3 categories we spoke, they automatically don't have entry-exit loads beyond a couple of months. But a short-term fund can actually have an exit load of 3 months. If you're not prudent enough to check whether this specific fund which you're buying has an exit load, you might lose a large portion of the return in the form of exit.
But unlike liquid and liquid plus, short-term funds actually give you the opportunity to make more than just the interest rate that you see, right?
Correct. Marginally, yes. If the interest rates fall in that 12-month period, if the interest rate was 7%, you might end up making 8%.
Right. And beyond 12 months, I know then it goes into a long-term time horizon, but there are still debt opportunities beyond that 12 months where some people can consider this instrument, right?
Sure. So if you look at something beyond 12 months, then you have 3-4 other categories. Dynamic bond funds, which actually are managed by a fund manager very dynamically, not very statically. So dynamic bond funds, when you want to delegate both credit risk management and also the management of interest rate opinion, which is very difficult for an investor to do. If you want to offload that work to a fund manager, dynamic bond funds are a good venue because you don't have to be as agile. If you buy another fund, you need to do monitoring more. But if you bought a dynamic bond fund, the fund manager is doing that monitoring. So they become a very important part of one's financial plan.
Feroze, in our previous episode, we talked about the ways to invest in equity mutual funds. You know, we talked about how we can do an SIP. Similar ways to invest, I mean, a lump sum investment, a systematic investment plan also applies to debt mutual funds?
Yes. All debt mutual funds have, except liquid funds, because liquid funds have a minimum amount, which might not be fulfilled. Some liquid funds actually have a 1 lakh as the minimum amount. Right. Okay, withdrawal has no limit. You can put in 1 lakh, then withdraw 4,000 rupees, 5,000 rupees, but minimum amount becomes not big enough to not have a systematic investment plan. Barring that, all debt funds actually have a investment which can be in one.
And how easily can this be redeemed?
See, I think debt fund has one very important feature now that we are speaking of redemption. Yeah. Redemption is very easy to answer your question, and it takes about T+2. So the day when you put a redemption, it takes you 2 working days for that money to come back to your bank account. But now that we are on the topic of redemption, something which an investor should definitely keep in mind is systematic withdrawal plan. SWP. Debt, because of its stable nature, can give you a recurring cash flow. And if you use the SWP rather than a dividend option, option, tax efficiency almost becomes enormous for you to ignore. So systematic withdrawal plan, you put your money and withdraw on a monthly basis without you having to send a form for a withdrawal on a monthly basis. So that's one thing you should keep in mind.
Well, thanks for that, Feroze. Good talking to you as always. With that, it's a wrap on this edition of Financial Planner. Thanks for watching.